Welcome again, and in this video we'll be discussing about the earnings quality. So we know that earnings means, say, revenue less expense. So this is the earnings, right? So we can manipulate earnings, or we can smooth earnings by increasing, meaning artificially increasing revenue and artificially decreasing expenses. So in that way we can increase the earnings. Okay, so this is called earnings smoothing. So if you don't inflate, meaning don't alter any one of them, so you have better earnings quality. Okay, so earnings quality is the ability of reported earnings to predict future, whether it is upward or downward. Okay, so from the past earnings reports, if you can predict the future, so this earnings has the high quality. Okay, and let's see one thing. So think about Amazon's net income. As we said, earnings ability to predict the future earnings is the quality of earnings. Okay, so if we look at the net income, yearly net income of Amazon, see, from 2015 to 2020, we can see that it is increasing. See that it is increasing. Okay, so if we see these numbers in an image, see that we can see there is an upward sloping. So we can predict from this that the earning is going up, correct? So it should go up. So it means Amazon has best quality earnings, because from the previous year's earnings we can predict the future. Can you see that? Because it is upward sloping, it is going up. Okay, so the ability of reported earnings to predict a company's future earnings is the earnings quality. And now let's see temporary earnings. What is that? It results from transactions that are not likely to occur again in the foreseeable future and likely to have a different impact on the earnings in the future. They are the temporary earnings. Okay, so let's have one example. Think that gain on sale of an asset. Certainly in 1 year you have, say, for example, $100 million gain from selling of the company's assets, but you will not be selling the company's assets every year. So this will suddenly increase the net income of that year. Okay, so the next year this 100 million gain will not be reported. It means that our line will be here. Okay, then next year will be here. Can you see that? It means that you cannot predict the future earnings, whether it is going up or going down. It means that by utilizing temporary earnings, if you increase the permanent earnings or show that your permanent earnings is going up, this is not good, and it means that your earnings doesn't have quality. Okay, And the permanent earnings result from transactions likely to generate similar profits in the future, and maybe temporary earnings effects included in income for from continuing operations. Okay, so this is another one from this line. We can see that this is going up, down, up, down, up, down. Okay, so from this graph, what we can see, we cannot predict the earnings, whether it is going up next year or not. We cannot do that. Okay, so this is actually earnings smoothing. Okay, so let's think about the classification shifting. What is that? So shifting operating expenses to a non-operating expense classification to report fewer operating expenses and higher operating income. And let's see how it works. See that the normal income statement is sales less cost of goods sold. Then we have the gross profit, okay? And then we subtract the operating expenses, okay? And we get the operating income, this one. Now we subtract non-operating expenses, and finally we receive this operating expense. Now think that from these non-operating expenses and from operating expenses, if we transfer, meaning if we take out some money from these operating expenses, say it is $100 million, okay, 100 million we are taking out from operating expense and showing as non-operating expense. It means that in that case our operating income will go up. See that? And this is called actually classification shifting. It means that you are showing operating expense as non-operating expense. See that? This operating expense you are showing as non-operating expense. This is called classification shifting. Okay? Sometimes you may want to show the non-operating expense as operating expense. In both the case, it is classification shifting. See that? And this is how you may want to smooth your earnings. Okay? And what are the temporary earnings? So please pause the video and try to answer. What do you think? Earnings from transactions that are not likely to occur again. Yes, it's true. Earnings from transactions that are likely to generate similar. No, it's not. Earnings from transactions likely to have a different impact on income in the future. Yes. So D is the answer. And here you can see that the goodwill, business realignment charges, these are the costs, expenses, okay, that can be problematic, so that we can transfer some expenses from operating to these goodwill and other intangible assets impairment. We may show more impairment this year, okay, and business realignment charges. Here are the things. And restructuring costs include costs associated with management's plans to materially change the scope of business operations recognized in the period the exit or disposal cost obligation actually is incurred. Examples: termination benefits payable to employees to be terminated and costs associated with closing facilities. So these are also costs by which you can smooth earnings, okay? Restructuring cost. There might also be some unusual items, long-lived assets impairments, revenue issues affecting earnings quality. In that case, a company loses a major customer that can't be replaced, misstatement of revenue, premature revenue recognition. These are also problematic. Okay, so I hope you understood what is earnings quality and what is classification shifting.